Ding, 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 ding. Hey, welcome everybody to the BBC, and by BBC I mean Bald Brokers Club.
Hey, come on.
Hey, well, Scott, join the club, man. All you need is a pair of clippers.
I'm getting there.
Okay, all right. Well, actually, everybody, welcome to Canadian Mortgage Hangout.tv. My name is Gordon McCallum, coming at you live from Edmonton, Alberta, Canada, broker of First Foundation Mortgages. We've got several other brokers here from right across Canada talking about mortgages today. Jackson Middleton from Regina, the Kilted Broker.
There we go.
Lift your skirt to everybody there, Jackson. How are you?
Not happening. I'm doing well, you? Right on.
Good. We've got a newcomer today, Paulo Di Petta from just north of the center of the universe. Where are you, Paulo?
Yeah, I'm just north of Toronto in Vaughan. Most people probably know where Canada's Wonderland is, so yeah, just north of the city.
Welcome to Canadian Mortgage Hangout TV. You know, we got to really get a shorter name for this because it feels like a tongue twister every time I say it. Scott Dawson, our regular contributor and all-around technology guru. How you doing out in Vancouver, Scott?
Good. Doing better than this morning.
Yeah, so for those of you who are watching right now, we've done this already. So if it sounds a little more scripted or even a little more professional, it's because this is like a second go-around. We spent 20 or 25 minutes on online this morning. Google Hangouts on air were not working properly, so we tried something else. It didn't work. All it recorded was Scott, so it was kind of...
we tried.
Yeah, we gave it our best shot, but we're going to give it another shot now. We'll hopefully come in under the 15-minute mark or so. Guys, today... I think the agenda is wanted to talk with you guys, and maybe you've had a chance to think about it now since we've done it. We're doing it twice about designing. If you were a lender and you had all kinds of money and you were really looking to make inroads in the Canadian mortgage marketplace and develop a product that was both unique and innovative, that served the need that the clients have, while also being a profitable product for you as a lender. What would you do? And so I'm going to go from my left to right and get each of you to give me your thoughts on what, if you were designing that mortgage product, what it would look like and what would be important features for it. So, Jackson, why don't you start us off?
If I was designing a perfect mortgage product, I guess we should look at the foundation of how mortgage products are set up. And I mean, primarily what you're dealing with is, of course, credit, down payment, and income. I mean, most mortgages hinge off of those three factors. Just recently, and maybe this is my answer's this because I mean I'm just dealing with it right now. I've got a guy who's got a great credit score. He's got great cash down from the sale of a property, but the problem is he's changing over from one industry to another, and he doesn't quite have enough tenure in the industry to make it work. And both the lender and the insurer looked at it and just said, "Nah, we got to wait a little longer." I would say that if we had more flexibility in common sense underwriting, now I know that that's very vague and kind of, it's broad approach, but I like the common sense, the relationship underwriting. If there was a mortgage product out there that was more relationship based, like my relationship with the clients and, then with the lender, I think that would be solid. But as for the mortgage products available, I mean, I think there's quite a bit of stuff out there that's very good for our market.
Yeah, guys, maybe Jackson brings up a good point. Do you guys feel like there are enough product choices for Canadian consumers, mortgage consumers out there, or are there a lot of providers of the same kind of thing?
Yeah, I'll take that. At least out here, I see there's a lot of providers that provide the same product essentially, and they're all sort of competing on rate. And they're really not trying to actively, give people options. But I think that's also partially our industry's fault for really trying to, do the whole rate war thing. I think as a lot of us are more trying to define ourselves through other skills that we offer and other things we offer, I think that problem will start to go away, and I think we might get more options.
Scott, rate's obviously an important thing, and the mortgage consumer is conditioned to think about rate first and rate almost exclusively, I'm sure, in some cases, and all the other features kind of become secondary or blur into the background. Is there room for a Canadian lender to come up with something really innovative that maybe priced at a premium, but offers a really good value for that extra extra dollar amount?
Extra dollar? Yeah, I mean, it's obviously, and I'll kind of follow up with what Jackson's kind of talked about here with, relationship lending. This is an issue, that I come across a lot as well too. Is when we're working with clients, there's times when we're working with the clients for probably sometimes up to a year or longer before they're getting a mortgage. So we know them. We know them intimately. We know all their details. We know them as a person, right? So it's tough, again, having to send this off to a lender because all they're seeing is what we send in via Filogix, right? They see the numbers, and that's what they're looking at. They don't see, they don't see the demeanor of the person, and everything else. That can actually help build these files. So there's definitely some room. I think there's some room there. We're obviously handcuffed with that, with being if it's, I think you mentioned it was insured. We're handcuffed with what the insurers are their restrictions are putting on us, and we work within those boundaries. That's tough. I don't think that'll ever get fixed. If it's going to be a high ratio deal. In terms of products for like the perfect mortgage, I mean, from the consumer perspective, I prefer something that I try and coach the clients towards is something that offers some great prepayments options on there. Prepayments available anytime is a big thing that I kind of always push to clients.
As opposed to just on the anniversary date? Exactly.
That's a big one. That's a big one for me because I find people typically don't take advantage of those. That's what I find from the clients that I talk to. And a lot of times it's because if it's the anniversary date, they're forgetting about it. They sign their paperwork and they're probably not going to call you unless you call them to remind them that they have a mortgage.
Yeah.
For the most part.
Okay. Well, and you can tell, I guess, which lenders are truly trying to offer that flexibility versus the others who offer prepayment privileges maybe just because they have to compete or something like that. So
yeah, well, I think that's part of the discussion we have to have with clients over and top of rate. I mean, yeah. I think you said it as well. I think actually I'm going to steal this quote from you, Gord. Is you said clients think they need the lowest rate, but what they actually want to do is save the most amount of money.
Yeah,
I think you did say that. So that's kind of what we have to. That's where our job comes in.
Sure. Okay. Now, gents, we talked about this briefly this morning, but I just wanted to bring it up again. The concept of longer terms and not longer amortization periods. One of the major differences between the Canadian mortgage products that are available and the U.S. market, for example, are you can get a 30-year term down there, which means essentially your contract is you may get one rate for the next 30 years, there's various options in terms of getting out of those and that kind of thing. But is that something that we might see here in Canada? Are we gonna have situations where, as opposed to a 5-year fixed, we might see more people taking 7-year terms, 10-year terms, or will there be some product innovation and go to 20, 25-year terms? For people and let them get one mortgage for life at one rate and just lock it in. Do you think that'll happen?
I don't know. I can't really see it. I mean, the longer term, I guess the advantage in having a longer term is the rate would be secured for a longer time. But let's say you lock in at 7% and 2 years down the road, rates are at 5%. What are you going to do? Right. You're going to jump down to the next 25-year at 5%. 2 years down the road, they go down to 3%. Excuse me. And now all of a sudden, the lenders are in a no-win situation. There's no way they're going to, you look at our market right now, and let's be honest. Okay, all of us put our money together. We decide that we're going to open up a lending institute. We put $300,000 down, and we're going to lend it and get how much return? 3.09% for 5 years? Forget it. I'm not lending my money. Just even the lending climate we've got right now, I don't know. There's something that's pretty sweet to borrow money for 5 years at 3.09.
Oh, it's great. Yeah.
Locking that into 20 years. I want my money back. I could come up with a better investment than that.
Well, but keep in mind, the 309 rate isn't exactly what the lender's making. They're leveraging, they're borrowing it at 1.5 or whatever, and then charging more. From an innovation standpoint, one of the things that I think it'll be interesting to see if our mortgage industry goes in the same direction that insurance is going in. And I've been learning a lot about the insurance industry lately, and one of the things I've seen is that they're really getting specific with their underwriting. So they're underwriting insurance risk based on postal code. They're doing credit scoring, which might you might wonder why would my credit score impact my insurance premiums, but they have found a statistical correlation between good credit scores and bad credit scores and how that impacts the likelihood of claims. Postal code, if you're a postal code, you're more susceptible to hail damage, or you're more susceptible to sewer backups, or more susceptible to vandalism, things like that. That'll affect your premiums. I'm wondering, do you think that refining the pricing model for mortgages, is there room for some innovation in that regard, particularly around, like, right now you could take a range, you could take somebody with a credit score of 650 right up to 850. You could have one person self-employed, essentially, with enough equity to qualify. You could take a particular type of property, maybe a subdivision that's less desirable from a marketability standpoint, versus another property that's in a much more desirable price point or much more desirable market, and their mortgage rate is exactly the same. So that seems to me to be just a matter of not having the tools or not having the data to maybe make more pricing decisions. I don't know if there's any legal impediments to becoming more specific about pricing. If you could make the case that they're different risks, then I don't think it's price discrimination. I think different risk requires different pricing. Guys, do you think that would go over in the marketplace? Would enough people benefit from that lenders would try it, or is it just too difficult to segment the market that way?
I think you're going to need to take a really careful approach if you start doing that, because you're almost segmenting the market, but you're almost restricting them as well. I mean, if it gets a lot harder for somebody to sort of dig themselves out of a hole that they're in because of where they live and their financial situation, it's going to be really, really tough for them to work their way out. Like we mentioned a little bit earlier, I think it would almost be better to incentivize good behavior for your mortgage. Not exactly sure how to do that, but I think that would be a better way. And maybe if people just don't take advantage of the incentives, then you can, I wouldn't say penalize them later, but I mean, when it comes to renewal time, maybe you just don't give them the same sort of benefits you give someone who's doing really, really well. Okay, so rather than punishing the negative, you encourage the positive results that you want. Yeah, and I'm sure there's lots of incentive psychology that supports that. I know, you look at compensation systems and other kind of reward systems. That's a valid point. And I guess one of the challenges with using algorithms or artificial intelligence to decide how your pricing goes is there's always going to be lots of room for debate. And we see that even with credit scoring now. All of us have seen an Equifax report or a credit report of some kind come back that where the beacon score maybe doesn't reflect what we feel is an accurate representation of the client's credit risk. What do you think about that, Scott?
Yeah, I mean, there's what was a new product that was announced? Was it last week? What was it? Was it Exceed Mortgage? I think I don't use them, but I read it on the Canadian Mortgage News, the website there, where with the borrowers that were over I think it's a 740 or 750 beacon, actually got better rates than people below. That was kind of posted last week. Yeah, I mean. So that's a smaller lender trying something like that out and trying to get it. Yeah, it was a discounted rate. I think it was it was obviously lower than what's kind of available in the market in general. But I guess the issue there is the transparency of we can't give a client their credit score, right? With our licensing with Equifax, we're actually not allowed to give them the report. So that kind of puts us in a position, all of a sudden, having to tell the client, you don't qualify for that rate. I can give you this, and they're going to say, well, why? But we can't actually show them why. Do you guys ever play that game of high-low, guess your credit score? 650 higher, 680 lower, working down. Maybe that's, I don't know if they guess it, do you violate the terms of your agreement? Yeah, I don't know. Or if they, if you're working and they see it sitting on your desk, I don't know how that works. Yeah, I think they audit you. I know they don't want your screens facing the client, so that's important. But well, guys, without getting off topic here, I think it'd be fun to continue this conversation and just around innovation in our industry. I think. It's easy to be a critic, and I know that sometimes we get talking about different things that are going on, whether it's D&H
expert outages or whether it's changes to the mortgage rules and things like that. But I think going forward, what'll be really fun is talking with people in our industry who are passionate about it and moving forward and want to find some innovative ways to do it. And I think there's probably some room for if there's good quality data out there to make to innovate from a product standpoint, whether it's features or pricing or both, so the Canadian consumer wins. But ultimately, it's got to make sense from a business perspective, and our lenders aren't stupid, so they're going to make a decision that's going to help them make money and hopefully set themselves apart from the competition. So anyway, everybody wins when there's lots of competition, and that's hopefully what we're going to continue to see for years to come. So nice to chat with you, gentlemen. I think it's time to go, but thanks for joining us, Paulo, this week on Canadian Mortgage Hangout TV. And
thanks for having me, guys.
Yeah, to all our viewers out there, we're sorry we missed you this morning, but technical glitches are taken care of, and we'll be back again next week, same time, same place. Bye for now.
Thanks, guys. Talk to you guys later. Have a good one.
Yeah.
Ciao.